I'm getting used to this. This is my second consecutive panel. I'm Iain Begg from the London School of Economics, and this time we're talking what next for monetary policy. It's a very topical issue. We're online, so I hope that there will be a further audience online. I have three excellent panelists here who are going to enlighten us about what's going to happen with monetary policy. Immediately to my right, we have Gediminas Šimkus from the Lithuanian Central Bank. You're the president or governor, I'm not sure which is the... Both. Chair, okay. Next we have Eleni Louri, who is a professor at the Athens University of Economics and Business, but has also been on many other things, including being a deputy governor of the Bank of Greece. And I never use the expression last but not least, because that means somebody else is least. We have from Serbia, from Belgrade, I hope I pronounced this one correctly as well, Dejan Šoškić. Thank you. And what we're going to do is to consider what's happening with monetary policy. It cannot have escaped you all that there's been inflation. There's been the accusation that the central banks, not just in Europe, but throughout the world, are very slow to recognize the threat from inflation. But we're now seeing the reverse of that particular proposition, which is that there's a clamor for interest rates to be reduced because inflation has come down, and yet the central banks are resisting. So are they making a further mistake, or is this caution exemplified by the fact that inflation in the US rose last month rather than fell, suggesting there might be future problems? So I'm going to start by asking each of the panelists separately to answer questions that I've already advised them of, and then we'll have a more open discussion among the panel. And the first question is to the chair. Gediminas, and that is, there's a degree of consensus that central banks were slow. They didn't recognize the persistence of inflation. They said it would go away in 2021. And the question now is, was this justified, and especially after 5 turbulent years, and what are now the main concerns that you see in monetary policy? All in 3 or 4 minutes.
Well, you said there's a degree of consensus, so I definitely fall out of that consensus, because I don't share opinion that central banks were somehow slow or irresponsive to the surge of inflation in 2021, 2022. I cannot generalize for all central banks, but I can refer to the European Central Bank, which situation I know the best. And the thing is that we need to take this broader perspective. First, our economies were living in a low inflation environment for a number of years. And then COVID-19 happened. And then the inflation surge, or the thing that sparked inflation, was supply-side shock coming from the recovery of the pandemics. The thing is that we know that monetary policy effectiveness in dealing with supply-side shocks is quite limited, because supply-side shocks are in their essence, in their nature, temporary or transitory. And if you recall the considerations, the talks about the monetary policy reaction back then in 2021, so that was the explanation. Let's wait a bit, it might be transitory, it might be transitional. If we knew back then what we know now, and of course this is impossible, but now we know that it was not the only one supply-side shock that happened in 2021. In 2022, Russia invaded the Ukraine, and this brutal war started. And this fueled energy prices, oil prices, gas prices, food prices. So there was another supply-side shock. So in fact, the inflation episode, this high inflation episode that we are now considering, actually is a consequence of series of supply-side shocks, sizable supply-side shocks. And once they started kicking in or being passed through onto demand factors, onto wages, because people started demanding the recovery of their purchasing power. So of course, the nature of inflation has changed, and the central banks reacted. And the reaction of the European Central Bank was decisive and strong. Remember summer 2022. And overall, the policy rates increased by 4.5 percentage points to 4% of the deposit facility rate. And in fact, in Lithuania, we have such a saying, we count chickens in autumn. So I believe we are close to the end. The last mile, but last mile is still ahead of us, but I dare to summarize even now that if monetary policy works, it was effective, and it really helped to bring down inflation on the disinflationary trend, and hopefully to 2% target quite soon.
Thank you. Eleni, would you like to comment on that initial assessment?
Thank you. Well, supply side shocks are transitory when we talk about one country, I think, or say an economic market. But in a globalized world, it became obvious that supply side shocks are much more serious and take much longer to get over. So although in the beginning I was convinced by the transitory inflation arguments of the ECB, and I do respect a lot their research, at the end of the day it looked as if they had missed this point that it was not exactly transitory, because in our globalized world it takes much longer for supply to get back to work, for the supply chains to work. So yes, I believe they were a bit late. Now that I'm not at the central bank and I can express myself freely, yes, I find the reaction was a bit slow.
Okay, I've been asked for a 10-second retort.
Well, I want to react because I think there's one thing very important. While one might consider that monetary policy tightening was or could have come a little bit earlier, it's essential to recognize that decisions are made on the comprehensive data analysis on the basis of data and understanding which is available at the time of a decision. Of course, now we know much more than we knew back then in 2021 or summer 2022. And therefore, we should judge about these policies not from today's perspective on what we know today, but what the information was available at the time of the decision.
Okay, point is made. Dejan, we already have a nice dispute. Do you want to offer an opinion?
I would very much like to join. Concerning the nature of this inflation that happened in 2022, I would say that it should not be too much of a surprise. And looking to the future, I think that we also need to a little bit look at the past. I think that we will all recognize who is the one who said that inflation is always and everywhere a monetary phenomenon, right? So maybe Friedman at the time did not take into account the possibility of changing the velocity of money, or maybe how hard it is today to measure what money is actually, when we have all sorts of different definitions and basically practical aspects of money. But the other one that might not be completely in line with Friedman is also, I would say, relevant for our current situation, and that is Keynes, who used to say before Bretton Woods that no single currency should serve dual purposes. And by serving dual purposes, he meant to be national and international at the same time. And we do recall the idea before the Bretton Woods, Bancor and International Clearing Union and so on. This idea actually, in my view, was advocated for the fact that no international currency should be reliant on one national central bank. Now, why am I saying this? Because if we look at the data, for instance, the Congressional Budget Office published the data concerning the budget deficit in the US. It was 15% of the GDP in 2020 and 12.4% of GDP in 2021. Altogether, it was fiscal but also monetary expansion, relying almost to the level of 5,800 billion US dollars in 2 years. So I wouldn't say that that has nothing to do with the inflation that occurred later on. And just to mention the following. Once you have these all international markets, especially commodities markets, using dollars as a means of payment and expressing prices. So once you have an inflation going on into the dollar domain, I would say that it's something that has obviously influenced to a certain extent what happened to the prices denominated in dollars, but also, and with this I will end, Eurozone and the countries which are related to Eurozone by fixed, more or less fixed exchange rate, like Southeast Europe is, where I'm coming from, had basically the dual inflationary impact. One was the increase in prices in dollars, the other was increase in dollar value against the euro, which obviously happens whenever you have uncertainty going on. So we had a double inflationary impact coming from that.
Okay, thank you.
Thank you.
Monetary policy is not just about the interest rate or the inflation rate. It's also about all these new techniques that were used during particularly the global financial crisis and the sovereign debt crisis of asset purchases. I know asset purchases are nothing new, but they were monumental during these two crises. Eleni, let me ask you the question. How do you see the unwinding of those assets? What impact will that have on monetary policy?
Well, it has to take place, but it has to take place slowly and carefully, and always monitoring developments. I mean, okay, we have a huge amount of, liquidity in the market now, and well, it's been reduced. I mean, quoting from a speech by Isabel Schnabel on the new operational framework of the Euro system, I quote that excess liquidity has fallen by 1.2 trillion from its peak of 4.7 trillion in mid-2022, and by the end of 25, it is expected to decline by another 1.4 trillion to 2.1 trillion. So there will be ample liquidity, but less ample liquidity than we have now. So, I mean, why do we have this ample liquidity in the market? Because this is how things developed after the post-COVID, well, the Euro system, the ECB, faced with persistently low inflation and the greatest economic contraction since on record, actually, due to the pandemic. The Euro system conducted large-scale asset purchases and targeted long-term financial operations, refinancing operations, injecting significant amounts of liquidity into the financial system. The reason was to keep up economic activity, of course, and this was achieved. Then came the opposite situation, the post-pandemic surge of inflation, and monetary policy had to reverse its course and be restrictive again, and hence the volume of reserves had to decline. So rates went up, volume of reserves had to decline. And so the transition from a situation of abundant excess liquidity, as we have at the peak of 2020, to one of less ample liquidity has few precedents, and there is uncertainty about how the market will exactly work out, and how the market participants will react. So it has to be done very carefully. Central bank reserves will start to be supplied from September, I think, onwards, will start to be supplied elastically upon demand and not upon supply as it is now, through refinancing, the main refinancing operations, as the ECB's balance sheet will start to get back to normal again. But the ECB declares that it will be done slowly, allowing banks to hold the optimal amount of liquidity they want to. And of course, how can you achieve that? There is no experience, it's a new thing. You go from this huge liquidity down to normalization. Well, what the ECB says is that careful monitoring of the evolution and the distribution of excess liquidity will take place. We have to make sure that the money market starts functioning again, gets live, it's alive again, They have to follow the formation of the money market rates, how they develop, and how the evolution of banks' demand for reserves is developing. And I suppose, you know, by careful monitoring, they will be able to react in the optimal way, so that they will facilitate the pass-through of monetary policy and, of course, you know, economic activity, and of course, price stability.
Gediminas, do you care to comment on what Eleni has said?
Actually, I very much comply with what has been said. Just to reiterate that we are very carefully monitoring how financial institutions adapt to a gradual reduction of the excess reserve, having access to refinancing operations, and how interbank market will redistribute reserves. But just one point to say that runoff of a monetary policy portfolio starts with the accumulation of monetary policy portfolio. And here what's important, that the Eurosystem's asset purchase program was performed proportionally along the yield curve from 2 years to 30 years. So runoff of monetary policy portfolio also goes gradually and smoothly, unwinding around 30 billion euros per month. And it goes surprisingly well. And just one more thing to mention, in March 2024, so this year, Governing Council announced the results of the review of the operational framework, and it is agreed that Eurosystem balance sheet will be normalized, making it leaner, so to say, and by this also creating monetary policy space for future countercyclical expansion if that need arises.
Exactly.
Right, but that's all very, very interesting, although I think we should bear in mind what happened in the US when there's an attempt to reverse quantitative easing. I sometimes call it, rather than quantitative tightening, quantitative diseasing, excuse the play on words. And it caused all kinds of international difficulties because of the rising dollar. So that's something to bear in mind when eventually this happens. I'd like to turn now to Dejan and ask him about the Western Balkans, particularly Serbia, which you know best, because, as you mentioned, the inflation rate was even higher in your country and neighboring countries. Is that a source of instability locally and maybe with a spillover to other countries?
Well, I would say that there is always, one element which is basically more or less unique to the Western Balkans, and that is the experience of hyperinflation that we had 30 or so years back. You know, so there is this psychological moment that still is something that may not be contributing to overall, let's say, stability. Yeah? But one thing that is, I would say, important also to underline, and I believe that it's not something that is being debated enough, is that all of these, so let's call them emerging markets, which are very much reliant on what is happening in large monetary zones like dollars and euros and so on, they very much actually have these spillover effects of the economic policies coming from these large regions. For instance, I mean, we tend not to recall, but when Paul Walker was fighting inflation in the 80s in the United States, he was, you know, famous for obviously bringing inflation down with his, at that time, called teenage interest rates, right? But as a side effect, you had sovereign debt crisis in emerging markets, you know, because Argentina's, Mexico's, Brazil's of the world could not keep up with these high interest rates, driving their budgets into bankruptcy, more or less, you know. So there are these spillover effects that we feel also in Southeast Europe. One of them is obviously that part of this inflation that we have was obviously imported from global markets. The other is also our very high sensitivity to what is happening with interest rates. Most of the loans given in Southeast Europe are more or less tied to the foreign currency clause. And these loans are given in relation to what is happening to Euribor plus something. So once the ECB does something that obviously reflects itself in Euribors, then Euribor is actually rising and falling down in our internal markets as a consequence of ECB policy more than the consequence of, for instance, our central bank policy. So the influences of policy making in Europe and even in the dollar zone is quite high. And one thing also to underline, there was, you can call it a favorable aspect of quantitative easing and so on, you know, a lot of money available, bringing the interest rates down, even for sovereign debt bonds issued by countries from Southeast Europe. But that has also generated a sort of understanding that these low interest rates are there to stay forever, basically, you know, inviting governments to take more loans, then they can maybe, you know, solidly pay back once you know, the situation with interest rates comes back to normality. So now I believe that some of these countries are also facing a little bit of a budgetary issues as well.
All right. Any quick comment on that, Eleni, since you used to look across the border?
Well, actually, as I said before, the markets are so much interrelated. So you can expect, you know, you cannot expect one country to raise rates and no problem happening to any other country. So as will be the case soon with ECB lowering interest rates, I mean, what the Fed will do, I mean, ECB says they are independent, but are they really independent? Because if they lower interest rates in summer and the Fed does not, then what is going to happen to the exchange rate? And then shall we end up with some kind of imported inflation by a lower exchange rate of euro-dollar? So it's obvious that markets are very closely interrelated, and you know, we have to be very careful. I mean, they have to be very careful when moving.
Okay, thank you. I want now to turn to a series of quick-fire questions, which I'll ask the panelists to answer in maybe a minute and a half each, which is quite taxing. And I want to start with Gediminas by asking him the very obvious question, which I'm sure you all want the answer to: has inflation been defeated?
Well, the last mile is really the most difficult.
Sorry, in saying that, I know that Lithuania has the lowest inflation rate. Maybe you can explain this.
But actually, we have had one of the biggest too, like just a little bit more than a year ago. So we had inflation over 20%. But maybe just quickly to react on what the previous speakers have said right now. It's not only about the financial market integration, but it's also about how the economies are integrated and which. For instance, Lithuania is very much integrated in the euro area, and the size of the economy and the centers of these, so to say, the centers of these economies matters a lot. So but not falling in it and getting back to the euro area's inflation. That's a tough question. And here now we are in Greece, and of course you know the legend of the Icarus, who was overconfident, and when he was told not to fly to sun, he flew. And then his wings melted because they are made of wax and feather. I think it's very important not to be overconfident. Yes, inflation is clearly on the disinflationary trend, and we project inflation to get back to 2% target. But at the same time, with the economy, so to say, being flat over the last several quarters, we have very tight labor market. We have wages, yes. The preliminary data indicate the declining trend, or the growth levels are we are starting to decline, but at the same time we are twice as big as we were in the previous years. And domestic inflation, for instance, it's quite above the medium target. The same service inflation, which is mostly dependent on wages. So there are clearly very good news on the inflation front, but to declare victory is too early. In Lithuania, we say, don't say yes before you jumped over the, so to say, the hole. So don't say yes, we are not yet over, but we made substantial progress, and we can afford less restrictive environment very soon.
Dejan, let me ask you, if you can give the audience a simple explanation of why inflation seems to have fallen so quickly.
Well, thank you for that question. I think it's very much related to why the inflation picked up so quickly as well. Because in my understanding, despite the fact that we say it's a supply-side shock, I think that there is a difference between the supply effect from 1921 and the one coming from 1922. In 1921, you had really the breaking.
I think you mean 2022.
Yes, I'm sorry. Yeah, I'm living it past, obviously. Yeah? So 2022. So in 2021, definitely there was a breaking of supply chains. We had interruptions in China, you know, the lockdowns and the containers not evenly distributed around the globe and so on. But in 2022, we had, in my view, one aspect, which is basically rise in uncertainty of potential supply shocks. And in my view, what was happening was let's say, the channel of influence going from derivative markets on commodities, futures and options on commodities, connected to the spot prices for commodities, connected to the wholesale prices for commodities, retail prices for commodities, and directly into the CPI. Why am I mentioning this? Because when we look at what was happening with commodities prices in 2022 and 2023, we basically see the peak after the invasion of Ukraine, when uncertainty has risen, and then we see that all of these prices, gas, wheat, oil, you name it, came back to the level where they were before. And in my view, that is, to a certain extent at least, because we have something which we tend to call financialization. And that means the banks and other financial institutions which have access to cheap money when the money is cheap also have the access to derivative markets on commodities where they obviously cannot take the delivery. And they are the ones, by having the access to these markets, in my view, that contribute to the volatility. And then there is a very direct connection between derivatives markets and spot markets, and then all the way to the retail and CPI, and especially in times when you have uncertainty concerning the elements which are directly in the CPI affecting the livelihood of average people, you know, like energy, food, and the like. Thank you.
I think you give us the entry onto my next question, which is about financial stability. Eleni, you are on various bodies which have to look at financial instability. A year ago, there were many fears. Credit Suisse had gone down, Silicon Valley Bank had gone down. Has financial instability disappeared as a challenge?
Well, I'm not sure if financial instability can ever disappear, but I'm sure that...
On a scale of 1 to 10, then, is
okay,
it back down to 2?
Well, in Europe, we've taken so many measures, and we have such a strong framework of supervision, of resolution, and you know, monitoring. So I believe things are much safer now. I mean, you know, if you can ever exclude financial stability from your life, I know this is not possible, but I think a lot of institutions have been built there to make the financial world much safer in Europe. That's why I believe we haven't seen many repercussions from the California bank crisis coming to Europe. We haven't seen even repercussions from the Credit Suisse decline coming to Europe at all. So I believe that there are many institutions in place now and many rules in place now that make financial instability more difficult to appear.
Okay, thank you. Gediminas, you wanted to come back, and then I have another question for you.
I just wanted to react to Mr. Dejan's explanation why inflation came down that quickly. I think the elephant in the room was forgotten. Central banks were doing their monetary policy, and it was transmitted, and it worked quite effectively to bring inflation down. So I find this important to mention, that there are institutions who were doing and whose job is to get inflation back to targets.
Can I just say a brief comment? Yes, but what is basically deflationary in the system in the past couple of quarters are the energy prices which were going down, okay? And they were reliant on what is happening in the spot and forwards and futures markets.
So a positive supply shock, in other words. Yeah. And I have to move on if you don't mind. You can arm wrestle later on this. In 2021, we had the first review of the European Central Bank's monetary policy strategy for 18 years, from the legacy of Otmar Issing. And I wonder, given the promise that it's going to be reviewed again far more quickly, probably in 2 years' time, whether there are now features of the European Central Bank's monetary policy strategy that you think should change. It's all right, I won't tell Christine.
That's a tough question because when you are, so to say, fighting the inflation, you don't think about changing, so you don't change the horse when you are in the water. So one thing, but for me it's much easier to think about the principles that were derived or were made in Strategy Review 2021, and they should remain in place. So first, the symmetry of the inflation target, and implying that both negative and positive deviations from the target are equally undesirable, and then 2% inflation target over the medium term, acknowledging that some short-term deviations from it are inevitable, and central bank's flexibility in the use of instruments depending on the context specific. So these are the things that I think definitely worked very well, and then I kind of read or hear the discussions. Some time ago, actually, I need to mention here too that inflation, maybe the inflation target should be revised. I said no way, because it would disturb the expectations of the economic agents. It would be suboptimal, and it would may increase the inflation risk. So maybe I have not answered the question the way you asked, but I think some very good things were done in the strategy review in 2021.
Although I do point out that the Fed has a rather more ambitious revision of its inflation target at more or less the same time in 2021. We're getting close to the end of the panel, but I do want to leave each of the panelists a good minute to give their last remarks. And in doing so, I'd ask them to consider two things. One is anything to say for Greece, particularly for Greece, since we are being hosted in Delphi. And second, there's a famous saying by the former governor of the Bank of England, Mervyn King, that no monetary policy was succeeding when it became boring. So let me give each of the panelists a chance in just over a minute to answer that, starting with Eleni.
Well, I suppose you want me to ask about Greece, to reply about Greece, okay. What are we expecting? We're expecting, in June probably, or we say in September, some reduction in the interest rates. So how this is going to affect the economy, I suppose that's what you want to ask. Banks may see their profits getting lower, but on the other hand, the economy will pick up. So maybe from the real economy side, they're going to see, increased profits. So, I don't think it's going to influence in a negative way in general, and I believe that this kind of normalization of monetary policy is going to, and getting to this level of being dull is going to help the economy, getting back to normal, I think.
Okay. Dejan, 1 minute, in which maybe you could also consider as an outsider from all these three countries, how you see what the ECB has done, what the Fed has done, and what the Bank of England has done.
Oh, well, that's a tough one. What I would say that is whichever country joins the Eurozone actually needs to understand that it's a two-way street. You need to give away something in order to gain something, right? Now, what is giving away is actually the independent monetary policy, and none of the countries in the Eurozone have it. So it's not easy to have an ideal monetary policy that is going to be completely in line with your national economic cycle. So I would say that is something that can also be applied to Greece, but also to the other countries, and to a certain extent to the region where I come from, because one could argue that we do not have much of an independent monetary policy, despite the fact that officially we do, because the influence is so large. But if you allow me to use half of my minute to say my personal impressions.
20 seconds, watch the clock.
20 seconds. First of all, conclusion from this episode of inflation, in my view, is quantity of money matters. The other is large currency areas should be aware that what they are doing for their internal purposes may have a global impact on global inflation. And thirdly, it's financialization, and the role of financial institutions on commodity markets and volatility of these is a very important issue that I would say deserves a debate. Thank you.
Gediminas, you have a minute.
Well, Probably two things to Condi. First, European Euro system demonstrated a high degree of agility, and agility it's very important in nowadays. Both easing the monetary policy when the pandemics hit, and fighting the inflation, deriving instruments, new instruments, unconventional instruments such as PEP, OMT, and others. Then the surge of inflation needed to be fought. Second, monetary policy worked out last year. Then we gathered in Delphi Economic Forum. Inflation in the euro area was 7 or 8%. Now it's a little bit above 2%, and in 1 year, in next Delphi Economic Forum, it's going to be around 2%. So it works. And third, victory maybe is not with us, is not complete, but we are clearly inflation on the downward trend, and wouldn't be mistake. Let's not let the horse of Troy to enter the house, and let's fight it to the end.
Right, thank you. I retain from this panel a degree of optimism to which I, as a good Scotsman, will try to be very dour and say, be careful. I think there are piranhas and sharks out there that are going to cause trouble for monetary policymakers. And with that, I'm afraid our time is up. So may I ask you to join me in thanking the panel in the usual way.